Do you know that it is possible for you to become a millionaire during your lifetime? Yes, it is true. You could become a millionaire during your lifetime. To become a millionaire, you don't need to win the lottery, win a contest, appear in a game show, or have a job with a large salary. All you need is some money to invest, time, and willingness to take some risk. Oh, come on! Now you might be wondering, am I guaranteed to become a millionaire? Of course not! There are no guarantees in life. However, odds are, if you are willing to take some risk and invest some of your money, you very well may make $1 million or more during your lifetime. Do you want to know how? Keep watching this video. Hi there, welcome to Investor's Game. Today, we're gonna talk about ways to become a millionaire. And give us a thumbs up, that helps us a lot. So let's get started. Let's say you wanna become a millionaire in 5 years. If you're starting from scratch, online millionaire calculators estimate that you'll need to save anywhere from $13,000 to $15,000 a month and invest it wisely enough to earn an average of 10% a year. That means taking calculated risk, diversifying, and avoiding investment fees such as loans and broker commissions. All of us have heard about work hard and save money to become a millionaire. And to be honest with you, this is completely false, because nobody becomes millionaire working hard and saving money. Just pay attention to this simple example. If we just save $5 every day, in 1 year, we will have saved around $1,825. And if we keep doing it for 100 years, we will have $182,000. And we still are way farther to reach $1 million. That means nobody can become millionaire working hard and saving money, not even in a century. Now, the next problem why you work hard and save money is that every time everything is getting more expensive. The food go up, the gas go up, the bills go up, and this is caused by the inflation. Inflation occurs when economy grows due to increased spending. When this happens, prices rise and the currency within the economy is worthless than it was before. The currency essentially won't buy as much as it would before. When a currency is worthless, its exchange rate weakens when compared to other currencies. The best way to fight against inflation is move the money constantly. We cannot leave the money sitting in the bank account hoping that in the next 10 years we're gonna be millionaires, because that's not the way it works. Usually, millionaires have different types of income, whether it can be active income, passive income, or manage their portfolio. They work with different sources of income. One of them is investing. Millionaires invest. They put their money into properties, art, stocks, bonds, and companies. Warren Buffett, George Soros started out with nothing. These entrepreneurs become billionaires by investing. How? By buying stocks, share companies, trading in currencies, and having controlled stakes in public companies. Taking risk in investment is not something they fear. Hence, most of their investments are riskier than the traditional. Yet, they usually reap hefty returns and increase their bank balances. But in this life, you have to choose how do you want to manage your investment, as an active investor or passive investor. What is an active investor? Well, active investing, as its name implies, takes a hands-on approach and requires that someone act in the role of portfolio manager. The goal of active money management is to beat the stock market average returns and take full advantage of short-term prices fluctuations. It involves a much deeper analysis and the experience to know when to pivot into or out of a particular stock, bond, or any asset. A portfolio manager usually oversees a team of analysts who look at quantitative and qualitative factors. Then, gaze into their crystal balls to try to determine when and where that price will change. Active investing requires confidence that whoever is investing their portfolio will know exactly the right time to buy or sell. Successful active investment management requires being right more often than wrong. One example of as an active investor is Warren Buffett, the owner of Berkshire Hathaway, along with his partner Charlie Munger. But now, what is a passive investor? Well, a passive investor invests for the long haul. Passive investors limit the amount of buying and selling with their portfolios, making this a very cost-effective way to invest. The strategy requires a buy and hold mentality. That means resisting the temptation to react or anticipate the stock market's every next move. The prime example of a passive approach is to buy an index fund that follows one of the major indices like the S&P 500 or Dow Jones Industrial. Whenever these indexes switch up their constituents, the index funds that follow them automatically switch up their holdings by selling the stocks that leaving and buying the stocks that's becoming part of the index. This is why it's such a big deal when a company becomes big enough to be included in one of the major indexes. It guarantees that the stock will become a core holding in thousands of major funds. When you own tiny pieces of thousands of stocks, you earn your returns simply by participating in the upward trajectory of a corporate's profits over time by the overall stock market. Successful passive investors keep their eye on their price and ignore short-term setbacks, even sharp downturns. Some of the key benefits of passive investing are ultra low fees. There's nobody picking stocks, so oversight is much less expensive. Passive funds simply follow the index they use as their benchmark. Next, transparency. It is always clear which assets are in the index funds. Next, tax efficiency. Their buy and hold strategy doesn't typically result in a massive capital gains tax for the year. Now, proponents of active investing will say that passive strategies have these weaknesses. It's too limited. Passive funds are limited to a specific index or predetermined set of investments with little or no variance. Thus, investors are locked into those holdings, no matter what happens in the market. Next, small returns. By definition, passive funds will pretty much never beat the market, even during times of turmoil. Sometimes a passive fund may beat the market by a little, but it will never pass the big returns active managers crave unless the market itself booms. Active managers, on the other hand, can bring bigger rewards, although those rewards come with greater risk as well. Now let's see the pros of an active investor. The flexibility. Active managers are required to follow a specific index. They can buy those stocks they believe they found. Next, hedging. Active managers can also hedge their bets using various techniques such as short sells or put options, and they are able to exit specific stocks or sectors when the risk becomes too big. Passive managers are stuck with the index they track holds, regardless of how they are performing. Next, tax management. Even though this strategy could trigger a capital gains tax, advisors can tailor tax management strategies to individual investors, such as by selling investments that are losing money to offset the taxes on the big winners. And what are the disadvantages of an active investor? It's expensive. Usually, brokers charge more when you buy individual stocks, because all the active buying and selling triggers transactions cost. All those fees over decades of investing can kill returns. Next, active risk. Active managers are free to buy any investment they think will bring high returns, which is great when the analysts are right, but terrible when the analyst is wrong. Here's the perfect example with numbers of how we can compare the performance of an active investor versus a passive investor. Warren Buffett has shown his report performance. Even though Buffett is one of the greatest investors, here we can learn how smart money can work for us. In this report, since 1965 until 2019, we can see that Berkshire Hathaway has gained 2,744,000%. If we compare that with the S&P 500, we can see that Berkshire Hathaway made 138 times more than the performance of the US economy. As we explained before, being a good and experienced investor doesn't mean that every year you're gonna make more than other years. Being an active investor is riskier, but brings more rewards. And if we look at 2009, Buffett gained a 2.7%, while the S&P 500 gained 20.6% that year. As investors, we have to understand that not every year will be like the last time. Every time we find new opportunities, new prices, new ideas that change in the market. So, which of these strategies makes investors more money? You think a professional money manager capabilities will trump a basic index fund, but they don't. If we look at superficial performance result, passive investing works best for most investors. Study after study over decades show disappointing results for the active managers. All of this evidence that passive beats active investing may be oversimplifying something much more complex. However, because active and passive strategies are just two sides of the same coin, both exist for a reason, and many pros blend these strategies. For more people, there's a time and place for both active and passive investing over a lifetime of saving for major milestones like retirement. More advisors went up using a combination of the two strategies. For someone who doesn't have time to research active funds and doesn't want to specialize on companies' valuation, passive funds may be a better choice. At least you won't lag the market and you won't pay huge fees. And for investors who are willing to bet at least somewhat involved with their investment, passive funds are a low-cost way to get exposure to individual sector or regions without having to put in the time to research active funds or individual stocks. But it doesn't have to be either or choice. Some investors have to build diversified portfolios by combining active funds they know well with active funds that invest in areas they don't know as well. Keep in mind, not all active funds are equal. Some might have lower fees and a better performance track record than their active peers. But remember that great performance over a year or two is not guaranteed that the fund will continue to outperform. As always, think about your own financial situation, your lifestyle, and your ability to tolerate risk before you invest your money. If you like this video, don't forget to hit the like button. Let me know in the comment box what kind of investor you are, passive investor or active investor. Let us know below. Subscribe to my channel because every week I'm in YouTube with new content, and do not forget to activate the bell so you don't miss any of our videos. See you next time.